Hello. In this session, we are going to do one exercise relating to accounting for receivables. So first of all, let's have a look at the information provided in this exercise. A toy wholesaler makes credit sales of $500,000 during the year 2019. Credit terms are 2, 10, and 30. So I'm sure you are aware of these credit terms. Oh, yes, very right. 210 simply reflects that any credit customer who makes the payment within first 10 days will be allowed a discount of 2%. So whatever his payment is, we will offer him a discount of 2%. So he doesn't have to pay 100%. He can pay only 98% and 2% will be given to him as a discount. And N30 is simply the total length of the credit that we are giving 30 days to the customer to make the payments. 20% of the customers pay within 10 days and avail the discount. 60% customers pay between the day 11 and 30 each month. Remaining 20% customers remain outstanding at the year end, and there is a customer who bought $4,000 worth of toys from the wholesaler, but due to financial crisis, cannot pay at all. Based upon the industry data, the business decides to create allowance for doubtful debts. Some time ago, a while ago, this allowance was called as provision for doubtful debts of 5% of the outstanding receivables. Tasks: show double entry for each transaction, prepare ledger accounts, which are mentioned here, show the amount of expense relating to receivables in income statement, and finally show receivables in balance sheet. So there are two things. First of all, we need to do some calculations. Once our number crunching is done, then we can do the debits and credits as well, and the ledger accounts. So first of all, we need to make sure that all numbers we understand everything. So here we can actually do some numbers. First of all, as far as the credit sales are concerned, or actually I can show here. Just let me remove this bit from here so I can have a bit more space here. Okay, so total credit sales during the year were $500,000, $500,000, right? And what we were told was that 20% customers pay within 10 days. So all we need to do is 20% of 500,000, 0.2 into 500,000. That simply gives me 100,000. Okay, so this is out of. Hold on, let me change this nasty color to something different. Okay, 20% customers pay within the 10 days. So 500,000 times by 20%, $100,000 as per the data provided were paid within the first 10 days. 60% customers pay between days 11 to 30 each month. So 0.6, 60% into 500,000. And not a difficult thing to do, which I think you are telling me $300,000. And what about the remaining 20% customers? Remaining 20% customers remain outstanding, unpaid or outstanding, making up $100,000. Okay, now what happens to this $100,000? Okay, what we are given, I can show you the question again. I mean, if you're not there, out of the 20%, which is 100,000, $4,000 of goods were bought by somebody who cannot pay because of the financial crisis. So one thing is very clear, that there is bad or irrecoverable debt out of this $100,000 that is worth $4,000. Now, after this, the remaining receivables outstanding come to $96,000. And what we are given in the very last sentence of the exercise, that the company wants to create provision or allowance for doubtful debts of 5% of the outstanding receivables. Now, outstanding receivables are $96,000. So 96,000 times by 5%. Okay. And how much do we get? Yes, you are very right, $4,800. So now all the numbers actually I've done. One thing, if there is any, yes, there is one thing, discount. 20% customers pay within the first 10 days. Within the first 10 days, 20% customers pay. Now, those people who are going to pay $100,000, they will get 2% discount, which comes to something like 2,000. It means they are going to pay $98,000. Rather than paying full amount due, which is 100,000, they will only pay $98,000. Right? Okay. So once basically these numbers are done, now let's do the journal entries based upon a chronological sequence. Chronological sequence means based upon the events, sequence of events taking place. So first of all, business is making the sales, credit sales. So we debit accounts receivable or trade receivables, whatever you call them. Trade receivables debit 500,000 and sales account credit by 500,000. Okay, first transaction done. Then some customers pay us within the first 10 days. So we debit bank account. And how much do they pay? 98,000. Remember, here I calculated that they were supposed to pay 100,000, but because they are getting 2% discount, so it means they will not pay 100%, they will only pay 98%. So debit bank 98,000, debit discount allowed as an expense, and we debit expenses 2,000, and we credit accounts receivable 100,000. Okay, and that transaction is done. Then 60% customers pay us the money after 10 days, which was something like, here my numbers are, 60% makes 300,000. So $300,000 debit bank account or cash and credit sales account, which comes to, oh sorry, my mistake, receivables. Accounts receivable, 300,000. It's done. Then we are told that some customers remain outstanding. Now there is no double entry, because now from here we can see what is outstanding. 500 minus 100 minus 3, so 100,000 is outstanding. But out of 100,000, there is some irrecoverable debt. You can see this one, bad or irrecoverable debt. So we can make the entry of this one. It's an expense. So we will debit bad or irrecoverable debt expense, that is 4,000, and we credit the accounts receivable. Okay, and what is this transaction? We are actually writing off a receivable. We are removing a receivable from our system. Okay, eliminating receivable from the system. That's 4,000. And finally, the provision or allowance for doubtful debts. So we debit the doubtful, not bad. They haven't become bad yet. Doubtful debt expense. You can even call it irrecoverable debt. It's fine. 4,800. And allowance or provision for doubtful debts, 4,800. Now all these double entries have been done. Now as far as the ledgers are concerned, you can see all you need to do is just take them onto the debit and credit side. For example, here you can see first of all is trade receivables. So here I can copy and I can paste here. It's the sales account which I can copy and paste on the credit side. Then here is the bank which I can copy and paste. Discount allowed, here is debit because it's an expense. Okay. And here is account receivable on the credit side. Then 300,000 goes into the bank. And this goes into the receivables. Okay. Then bad or irrecoverable debt expense. And this doubtful, I can actually make it or irrecoverable rather than making another account. Right? So this 4,000 first of all goes here. No, that's gone already, sorry. That 4,800 now. Okay. And the credit goes to the provision or allowance for doubtful debts. Sorry, one transaction I think is gone missing from me. This 4,000, which we written off, goes in there. I think all transactions have been recorded. All right. If I haven't recorded anything because I'm doing it so quick, you can work out. Now you can clearly see out of the 500,000, the balance carried down or carried forward, okay, that comes to 96,000. Then sales balance is the same, which is total sales for the period. Then they recovered $398,000 of cash. Okay. Right. Discount allowed expense, which gonna go into the income statement, which is something like 2,000. Then bad or irrecoverable debts, which is gonna go to the income statement, right? That's 8,800. Then allowance for doubtful debts, balance carried down, which goes into the balance sheet, 4,800. Now all these transactions in form of double entries have been done. Now what we can do is, third requirement was what amount should go into the income statement regarding the expenses in income statement relating to the receivables, accounts receivables. Now you need to look at very carefully. There were a few expenses which were recorded. Okay, for example, if you look at that, discount allowed, so 2,000 discount, then 8,800 bad or irrecoverable debts. So these gonna go into the income statement after the gross profit. So once we have calculated the sales minus cost of goods sold equals to gross profit. Then after the gross profit, in the expenses section, we will list down these expenses separately. Discounts allowed, which is 4,000, and irrecoverable or doubtful debts in total included 8,800. So this is the expense relating to the receivables, which is going to go into the income statement. Now, how the receivables will be shown in the balance sheet. So you can have a quick look, okay, in the balance sheet as on 31st of December or whatever the date is. So first of all, we write down accounts receivables, which are appearing as on 31st of December at the end of the period, okay, at year end. Now you will tell me what is the balance of receivables at the end of the year. Well, you can see that after all the transactions have taken place, balance of receivables is $96,000. That's the closing balance. Okay, and balance sheet is prepared at the end of the year. So this $96,000 goes in there. And then we subtract allowance for receivables, which comes to, I think it was 4,000. Allowance for receivables, I just double check. No, 4,800. Sorry, my mistake. 4,800. And if we deduct, so what we are saying is we are showing to the shareholders a risk against 96,000, that we feel 96,000 will be collected, but just in case, who knows, 4,800 may not get collected. So after these 4,800, the remaining are good customers or good receivables, which are called as net receivables, which reflect the good receivables. Okay, so 96,000 minus 4,800, that gives us $91,200 net receivables shown in the balance sheet. Okay, perfect. Thank you very much.